Hey everyone, this is Nick Saylor of Saylor Business Solutions and the VMG Real Estate Tax Group. This is video number 3 of a series I'm doing on the short-term rental tax strategy. We started with the basics of taxation. Next, we talked about the history of real estate and depreciation expense. And now I'm giving a deep dive to set the table so that you understand how the short-term rental tax strategy works by explaining cost segregation studies and bonus depreciation. As I explained in the previous video, the way that real estate can get really powerful for high earners when it comes to reducing taxes is 2 ways. One is by accelerating depreciation, by front loading the depreciation taken after acquiring a property rather than spreading it out evenly over 27.5 or 39 years, and also the ability to deduct that accelerated depreciation as an expense, as a loss against active income. So I'll explain here how we can do both of those things. Okay, I'm sharing my screen. So as you know from the last video, when you have a real estate property, you are able to take depreciation on it because it simulates the decrease in value of real property over time. If you're using something like an Airbnb, which we'll talk about here, you depreciate it evenly, straight line they call it, over 39 years. So here's the example. If you had a $700,000 depreciable basis, which that means that amount was allocated to the building, not the land, after the purchase, this is what it would look like for a 39-year property. Each year, you would divide one divided by 39 to get 1/39th of the depreciable basis. So this is just under $18,000 per year you could take to depreciate out a $700,000 depreciable basis. So as you see, we go all the way down, right? All the way from 1 to 39, same expense every year. This is great because you get some expense every year to reduce taxes. However, this is not what the wealthy use real estate to do to get ahead. Generally, there's more powerful things you can do, and I'll explain that now. As you may imagine, if you own a house, not all of your property will last 39 years. There's pieces of your house that would expire sooner, that you would need to replace sooner. But if we are just bulk categorizing things, we have to do 39 years. So this is where the cost segregation study comes into play. You may have heard it before if you're looking into the short-term rental tax strategy. You've probably never seen a cost segregation study before. I'm going to show you exactly how it works since I have done this before. Before I show you, we'll just visualize this here. So as you see, 1/39th every year. But if we were able to say that some property doesn't last as long as 39 years, maybe it only lasts 5 years, 7 years, 15 years, you would see more of this depreciation on the front end, and that's what a cost segregation study does. Big commercial real estate businesses do this with their commercial real estate they hold. All sorts of people do cost segregation studies for different reasons. So I'm going to bring this over onto the screen. This is a cost segregation study that a client of mine did that I prepared the taxes for. So I wiped out all personal information, but an engineer comes out to the property and looks at the house. And they break it down piece by piece, and it's pretty crazy. You'll see like they walk through the entire house, and every material in it gets broken out because some is 27 or 39-year property, but there's also 15, 10, 7, and 5-year property. So here is what it looks like. They show a summary. This is the summary in the end, and they had originally marked 27.5 years because it had been a residential rental prior. But the total building basis, the total depreciable basis was $526,000. But after they did the study, they were able to allocate $66,000 to 5-year property and $135,000 to 15-year property. So just right here, you can see if you divide this 66,000 by 5, you could accelerate an extra $12,000 of depreciation in the first 5 years instead of waiting for the back end. Now to show you some more details on how this looks, just because it's interesting, they'll put together some things, and that's really what I just showed you. Total reclassified property was $202,000 that went to either 5 or 15-year property. Now, what I haven't touched on at all yet is how you can use these losses, this depreciation, against your active income and how you can accelerate it even faster. Bonus depreciation is a thing. We're going to talk about that soon. But with bonus depreciation, you are able to 100% deduct any of this property, anything 15 years or younger. So before, if it was all 39-year property, we couldn't use bonus depreciation when we buy it. But now that we have 5-year property and 15-year property, that's about $202,000. we could take bonus depreciation and fully deduct this in year one, $202,000 of expense added on. And if you follow the steps to do the short-term rental strategy properly and hit material participation, don't break some other rules, you can count this against your active income. So that's where this gets so powerful. Now, just for fun, it's more just breakouts. There's accounting stuff you have to do. You need a very skilled accountant if you are going to do this. And I was able to, take care of this along with some other things for the client. But here are some things you can see. So they mark everything in the building, 27 to 39 year. This is concrete. So, just this had $33,000 value in concrete. Masonry was $11,000. Again, this is all 27 or 29 year stuff. So most of the stuff you see in a house is 27 or 39. But as we start to get here, there's some electrical type things that are just 5 year. That's $1,500. And then you get into some wood and plastics. That's $2,300. So this adds up as we see it. Finishes, so like carpet pad, laminate flooring, that's 30 grand of stuff that we can move forward and bonus depreciate. I won't go through every single one of these as we've already seen a lot of it. But what this really worked out well with is things like lake houses, or when you have like maybe special guest little shacks, whatever. You can see that the cost seg engineers were able to give these special construction like boathouse, storage shed, utility building. That was all 15-year property because it's temporary building. So that was 62 grand. I was able to go onto the bonus depreciation. So super interesting stuff when you look at this. That's how you accelerate depreciation with a cost segregation study. So right here is an example of this. So I didn't use the exact example we just saw, but what if, we were able to accelerate some of this and we were able to take 30% depreciation in year one instead? All it would do is it would reduce the next 38 years by about $5,000 per year. So what you're doing is you're front loading that depreciation, sinking it all in 1 year, getting a huge tax benefit in year one, and then in future years, you're not impacted too much. You don't get any more depreciation by doing this, you front load it. And you can do the same thing in year two and year three with different properties. So it's kind of like a way to never pay much tax and just keep acquiring properties. Here's an example of just some rental, a rental P&L basically to show, what you could make on the property. Now, these are completely random numbers, so I don't know anything. And whenever you're buying a short-term rental, you should be thinking, am I going to cash flow? And is this property going to appreciate? Tax benefits are just tertiary side awesome things that I can help you with, but you need to find a good property because this is never worth doing if you're buying a bad property. Okay, so let's say you got $50,000 in rental revenue in the year, and these are like cash expenses, mortgage interest, cleaning. You'd have mortgage principal too, so consider that. But your total expense is like $27,500. So your net expense before depreciation would be $22,500. So if we were doing standard depreciation, you would see that it would get your taxable income down to $4,500, and you'd do that forever. The cost seg model is a little bit different, where you would generate like a massive loss in year one. That if you did it right, you could count it against your active income. $187,000 if you're in the top tax bracket and you're in a state with taxes, you could save, let me type this in, times 0.42, that's a top tax bracket with 5% in the state. That could save $79,000 in taxes. So pretty significant. I also just want to model this, I want to show it to you in one different way. And this would be purchasing an $800,000 short-term rental with a cost segregation study. This left panel is without doing a cost segregation study, and this right panel is. So the details are the same. You'd have like a $200,000 down payment. The property would cost $800,000. If $100,000 was allocated to land, that would leave you with a $700,000 depreciable basis on the house. Now, if we did not do a cost segregation study like we see in this left panel here, all of it would be 39-year property. So again, I think those are the exact same numbers I use. They are. So that divided by 39, you would get just under $18,000 of a deduction each year. But if you did do the cost segregation study on this $800,000 property, I modeled out what probably wouldn't, it's not exact, but it's just random numbers that are near the rates that you might expect. You could see if these amounts were allocated to property that was 15 years or less, you could get this entire tax deduction, $261,000 tax deduction, when at the federal tax rate of 37% would save you $97,000. So pretty huge. And if you factor in state taxes in there, like we said before, over 100 grand in taxes. So obviously it costs money. You know, you need to pay the down payment or you need to buy the house in cash. So it's not necessarily always a cash flow positive thing to do this, but if your goal is to not pay taxes and to build wealth and you have the money to do so, this is super powerful way to do it. I thought it'd be helpful to see that cost segregation study. I thought it was super interesting the first time I did one of those. And when you see it, you know, modeled out over 39 years versus accelerating it, it's pretty neat. So stay tuned for episode 4. Drop a comment down below if you have any questions. And thanks for watching.